now there's something called the Secure Act. The first Secure Act was passed in 2020. It kind of got a little overshadowed because of COVID just a couple months later. And then the Secure Act 2.0 was passed in 2022, January. And it did a few things that we're going to talk about here. So number one, it increased the age of the required minimum distribution to 73, potentially 75%. And this is, in short, a required withdrawal that you must take out of any traditional accounts that you have. We'll kind of cover that in more detail here shortly. It also removed the requirement to take that money out of Roth accounts from a employer plan like the TSP. In the past, people would simply move their Roth TSP money to a Roth IRA ahead of a required distribution so that they weren't going to be forced to take money out of their Roth TSP. Another very interesting thing that happened here is if you over contribute to a 529 account. So again, this is a college funding account used for kids or grandkids. But if you overfunded that account, and that account has also been open for more than 15 years, you can actually use money from the 529 to contribute to a Roth IRA for that beneficiary. So if you had a kid who got a scholarship, let's say, right, or they got some financial aid that wasn't originally anticipated, or they went to a cheaper school, or whatever is the case where you have some excess money in that account. Now, they would still need income and some of those factors of their own. So this would be kind of post-college you'd be looking at. But you can use the 529 and you can send whatever the Roth IRA contribution limit is. Let's say for this year, it's $7,000. And you can send $7,000 a year into a Roth IRA for your kid, which can essentially jumpstart them on their retirement savings. So this kind of helped because there's a lot of folks who had some leftover money in 529s. And if they pulled it out for anything but education, there was a 10% penalty. So if you're, funding an account for your child or grandchild, this is now something new where you don't have to be as concerned about overfunding it. Now, you don't want to overfund it too much, of course, but you don't have to be as concerned about it being a little bit overfunded because there is now a method or a feature where you can use that also for their benefit. Finally, this is from the first Secure Act back in 2020. I know we do have this here in the 2.0, but it is very important. Is it changed the way that a non-spouse will inherit money from a retirement account. So if you pass away and let's say you had one kid and you pass away and you give them $500,000, they're going to have to empty that account. Now, it doesn't mean spend it, but they're going to have to take it out and pay taxes on it. And on that $500,000, they might be taking out something like $60,000 a year because it's hopefully growing as well, in order for that account to be empty. And the big thing here is by the 10th anniversary of somebody's passing, the entire balance must be emptied. So for most people, their parent may pass during their peak earning years, right? Somebody in their 50s, right? Their parents might be in their 70s, 80s, even 90s. And if that parent passes, you're in your peak earning years and you have this extra income on top of your own compensation. And oftentimes we've seen that can jump somebody's tax rate into a higher tax rate than the parent would have been in anyways. So there's a little bit that we're going to talk about kind of on that tax planning here. But let me walk you through a scenario here, taking exactly that information and actually kind of briefly that scenario that I was kind of teasing a little bit with the inheritance, right? So if you inherit $500,000 and it grows at 5% a year, you're going to need to take out about $60,000 a year. right? And let's pretend that that's all going to be taxed at 24% federally. We're going to ignore state tax here, or for hypothetical purposes, let's pretend you're in a tax-free state. So at the end of the 10 years, what you would actually receive out of the account that was worth 500K because of taxes and accounting for growth is going to be 460K, right? 460 of the 500, which isn't bad, but it could be better. So I'm going to walk you through essentially how it could be better, right? So now imagine that that parent had been proactive in Roth and tax planning, and they had that money in Roth instead of traditional. So because that money's Roth, right? The Roth account still has the 10-year window for when you have to withdraw it. But because it's a Roth account, it's not taxable when you take it out. So there's no reason, unless you had, significant income needs, there's no reason that you would need to pull money out during the 10 years, right? So you would leave the 500K in there, let it grow at 5% in this example, completely tax-free. And at year 10, then you take that money out. So there's zero left in the account. And what you would receive, or the beneficiary, is 815K completely tax-free. So this is the power of Roth planning, and what we're going to actually have another more detailed scenario that will kind of walk you through how you should go about some of this planning. But this is the impact of utilizing Roth and utilizing it from a legacy planning standpoint.